Good morning and welcome to the April 10th edition of the Gold, Ghosts, and Guns Market Report. My name's Tom Luongo. We've got a lot to talk about, and specifically, I want to talk about an email that I received from one of our subscribers, from one of us, and I'm not going to name names or anything, but I'm going to read that email as prep for some of this, what I'm going to talk about today, because I want to, this is something that's been sitting for a little while. It's a big topic, and it's going to probably dominate most of today's discussion. But I think it's I think it's important that we do this every once in a while, because this one's a big one, and it's something I'm going to revisit. This is not going to be a definitive statement on this particular subject, but it is kind of an overview and a primer to get an idea of what the grand plan or grand strategy is. So let's get to that, and we'll get started. All right, so that's what bullet point number one is all about. So I'm going to read the email to you now so you guys have an idea of what I'm talking about. I've been thinking, from your advice, I sort of have got what happens when Europe and then Japan fall apart. I also understand what to do once the stock market in the U.S. has tanked. What I can't get my head around is what to do with investments once the stock markets and bonds begin to fall apart here in the U.S. and until all, including the dollar, have bottomed. I've thought about a glass jar and a hole in the ground. Smiley face. Would you please talk to some of us about what we could do for that phase? It would be a big relief. Okay. So there's a lot to unpack in there, and I can't address everything. But let's start with the basics. Part of what we've done in terms of the strategy for the portfolio is to have investments that will do well now during the dollar melt up, and will do well or even better when the dollar melts down. Right, and that they will be somewhat insulated from all of this. And part of what we're doing now is, and there's two main themes to that, and one is Russian energy, and the second one is gold. I think both of those are going to do really well in both phases of this scenario. So what we're in now, and which is also the subject of this month's newsletter, which we're in the final stages of. I should get out this afternoon to y'all, so it should be a big day. We got this, we got the newsletter, we got all sorts of stuff coming out today. Is that we should be entering, if not have already entered, the dollar melt up phase, and everybody is scrambling around, desperate to try and stop that from happening. Trump is, the Fed is, the ECB is, everybody is worried about a rising dollar because they know what's going to happen then. During the rising dollar phase, it's not going to be bad for the U.S. Okay, it's actually going to be very good. So our stock markets are going to rise. Our bonds are going to be bid, at least in the short term, in the first sub phase of that run up. It's emerging markets that will get hurt hardest, and then Japan and Europe because of their debt situation. Japan less than Europe, because Europe is exposed to so many cross currents of a global slowdown. Because once the dollar starts to rise, we're going to get a slowdown in the global economy, which is going to put pressure on debt everywhere. And eventually that will also put pressure on the United States once the dollar rises to a particular point, raising the value of the debts that we have to service, because that's running out of control, and it's not helped by Donald Trump's fiscal debauchery, as David Stockman has pointed out on multiple occasions. So now, once we're there, right, so we're kind of positioned for that now, and the thesis is going to be a shift from safe haven assets being bonds and gold to stocks and gold, and not specifically government bonds. Government bonds around the world are going to be sold as people lose faith in the ability of central banks to manage any of this stuff. Currency, as the dollar rises, currencies are going to get wiped out. It's going to force liquidation of a lot of sovereign bond positions. We're sitting at $10 trillion worth of negative yielding debt at this point. So that's the basic, situation. So that has to be relieved, right? And that means rates have to rise, and that number has to get down from $10 trillion to, say, zero, where everything is yielding positive. Got a positive yield across Europe. But what's that going to do to Europe? It's going to cause massive flight out of European assets and into U.S. assets. Okay, so we understand that, and that's going to send the Dow higher. It's going to send the S&P higher. It's going to send U.S. debt yields lower. And I've got a chart to show you that I think we're getting ready for the next stage of the meltdown in rates, or the bidding up of U.S. bonds. Concomitant with my thesis that all three of those asset classes, U.S. stocks, U.S. bonds, and gold, are all rising, right? So now, what happens on the other side of that, right? What happens then is, so you're going to want to be invested in those asset classes. And at the same time, you want to be invested, I think, in Russian energy because it's in a bull market. And because the Russians have decoupled their economy for the most part from all of this. And will be able to, drive strong profit margins. Because energy demand isn't going to collapse. It's just, especially in the face of a colder planet, what it means is that marginal businesses are going to get hit. Fundamental businesses are going to do very well, right? The ones that traffic in fundamental commodities, as food prices rise, as food prices and energy prices rise as a percentage of disposable income. That's what's going to happen during the recession. It's not that the nominal price of oil is going to go to $150 a barrel. It's that the world will not be able to afford $70 a barrel oil, or $60 a barrel oil, or even $50 a barrel oil. And who's in the best position to take advantage of that? Well, the Russians are. No one else who's a major oil producer other than Iran, really, is in a good position to take $50 a barrel oil. The Saudis would be if they would decouple the rial. Okay, so, and those will do very well, or at least relatively speaking, those will do well. They may not do great on a real yield basis. Everybody might get hit, in a financial crisis by a lot, say 30 or 40%. But the areas that we're invested in, we should only get hit by 10%, is my argument. Is that we're going to get hit less than everybody else if you pick the right stocks, if you pick the right, sectors, subsectors, right? So that's the first phase of this, right? And that's pretty easy to understand. Now what happens when yields drop in the United States, but then they start to rise along with everybody else, as everybody realizes that the Fed doesn't know what they're doing, and confidence in the Fed starts to collapse. Because once the prices overseas begin to drop, once the prices overseas begin to drop, that's going to then, at some point, reach a bottom. The euro's going to bottom, and then that's going to become attractive relative to expensive U.S. assets, and then capital will shift out. So while I hate Europe now, 3 years from now, I might be, the biggest Italian equity bull you ever saw. I may even be the biggest German equity bull you ever saw. You see what I'm getting at? So there's going to be, and that's what we're going to do now. And then we're going to shift from betting on a strong dollar to a weak dollar. And then we'll probably go, and we won't be short the euro anymore. We'll probably go long the euro. Depending on how things shake out with Brexit and the British political system, we may even go long the British pound or something along those, or some derivative on that. But through all of this, gold will do well, because gold will have to rise in price through all of this and then maintain that price level to deal with the liquidation of all of this debt that's overhanging everything, right? So that's where we are. That's what's come. That's the next phase of it. So where are we going to put the money then? And I think the last phase of the question is what to do after that happens. Well, after the dollar, again, that's like two phases of the cycle out. After the dollar bottoms and after and there's political upheaval here in the United States, you're probably going to be invested overseas. And is that going to be in Russia? Is it going to be in China? Where's the center? And we're going to find out where the next financial center comes. And that's a question for 2024, 2025, 2026. What are we looking at then? Is New York still going to be the financial capital of the world? My argument would be no. It may still be important, but it won't be the most important game in town. And I think that's the thing you have to wrap your head around. And no one wants to see the United States fail. No one really wants the European Union to fail other than politically. And the question is, are the people who are pushing this whole rotten superstructure that we have, are they going to exit the stage with any degree of aplomb and dignity? My answer would be no. And so therefore it's going to be as hard and tumultuous and as vicious and as virulent as it could possibly be as these people are dragged from the stage. And I think I used the phrase. I think I used the image the other night in my live stream that it's like the worst cabaret you've ever seen of a bunch of untalented people all standing on the stage screaming, I'm the star, I'm the star, I'm the Mary. No, I'm the star, and they're all fighting amongst themselves, and the audience is all throwing tomatoes and eggs at them, going, "Dudes, get off the stage," and they won't listen. That's where we are. And that's going to be a constant as well throughout all of this. And so always bet on that. And when that's happening and everybody's fighting amongst themselves and all of these competing agendas amongst, the Europes versus the Brits versus the Americans versus the Japanese versus the Australians versus the Chinese and the Russians and everybody else, when all of these various factions and sub-factions and whatnot are all fighting amongst themselves, that's chaos. And during chaos, you bet on gold. During chaos, you bet on somebody. You bet on people who don't have any debt. You bet on things that have no counterparty risk. And that's what you get back to. And so what you're always trying to do through all of this is identify where is the least amount of counterparty risk, and that's where you want to put your money. And that's what my job is to help you identify those areas. Okay, I hope this helps to give a broad overview of what we're looking at over the course of the next, 1 to 6 years. Because that is what's in my head. That's the way I'm positioning all of this stuff. And I don't know, I'm not going to be right about everything. I'm not going to get every stock pick right. Lord knows that's not going to happen. But hopefully I'll tell you some good stories and I'll keep you abreast of what's happening in a way that makes sense so that you can cut through all of this and it not be confusing. But remember, just when you start looking at what's happening, the reason capital flows from the U.S. to Europe, back to China, back to Russia, all that stuff, why these things happen, it's about counterparty risk. It's about, at the moment, where does the market feel, what place is the most vulnerable, and that's the place where they're going to run, capital is going to run from that. And then run, and that's what capital does. Because again, it's at the end of the day, in the game of global capital, you don't have to be good by any, Austro-libertarian perspective. You don't have to be good money managers. You just have to be better than the other guy. So we can all be vaguely commie, right? But as long as, if at the end of the day, the Chinese wind up being, 5% less commie than the United States and Europe, well, guess what? China's going to get all the money. Because that's the law of comparative, because that's where the comparative advantage is, and that's where the law of diminishing marginal utility is maximized. So that's honestly the way I look at all of this stuff. Okay, so I hope that makes some sense to you. Okay. The other bullet points are pretty obvious. Just to note, Bibi Netanyahu won re-election last night. I don't really think it was much of a shock to anyone. I was talking with Halsey last night about it. He's like, yeah, he might have, even if he had lost the vote and had fewer seats than Benny Gantz, it doesn't matter because he's still going to be the only one who can actually cobble together a coalition of 61 seats in the Knesset, and therefore he was going to always set the government. It was never really an issue. So that's all I have to say about that. We'll talk about the consequences of that maybe on Sunday or next week. Also, I'm not sure how much I'm going to be able to get done on Sunday. We'll see. Taxes are due on Monday, and I'm going to be probably scrambling to get that finished. But I'll try and get my market report out to you, even if I don't get very much written this week. Also, notice, I saw a thing on RT this morning. I just want to mention it briefly, that China and North Korea have opened up a new highway, adding to their cross-border traffic. And it's just another little bit of information to let you know that Russia and China are no longer working with the United States to affect or going on with the United States' plan to affect denuclearization on North Korean Peninsula. They've rejected that completely now. The breakdown of talks in Hanoi have left them with no other options but to then just keep going forward with opening up the North Korean economy, flaunting UN and U.S. sanctions and the rest of it. And that's what's going to happen. And Bolton and Pompeo and the rest of them are going to scream bloody murder. But do you really think that the U.S. 7th Fleet's going to, start attacking Chinese oil tankers and Russian oil tankers off the coast that are quote unquote illegally transferring oil to the North Koreans? Yeah, if you believe that, then I've got a bridge to sell you in Brooklyn, because that's not going to happen. It's just not. Okay. And then the last thing, of course, is that the Dow continues to defy gravity because of all the things we just talked about. All right, let's get to the charts and I'll get you out of here. Gold. So last week, on Sunday, I put up the chart of gold and I drew in some trend lines here to let you see that we do have a series of lower highs now and lower lows. Even though this is kind of weak lower lows, it's not a great kind of downward wedge pattern. I hate those chart pattern designations. But truth of the matter is that you have technically now a little bit of a downtrend in gold. Whether that's significant or not is another story. But you have to respect it. This week's action in gold is interesting and fun, but 1325 is the proof in the pudding. Now, it doesn't need to get there this week. It can get there next week. We're going to have a 2-bar reversal off of this, this 2-bar. So we had an uptrend and then a 1-bar reversal, 2-bar, and then boom. But remember, this reversal bar here is still dominant because this reversal bar here was never negated, even by this uptrend here. So, and then we have another reversal, bearish reversal of this bar. So that's a reversal within a reversal. It's just none of it's really strong technically. So you're going to need a statement by the gold market. And again, this is also a bearish engulfing bar. It's all bad. So, but does that mean we're going to see $1,200 gold? No. What it means is that gold doesn't have any commitment to go to 1350. And with Brexit being betrayed and everything, why is anybody shocked? With dollar liquidity tightening around the world, why would you be shocked? Gold is going to be, in dollar terms, is going to be under pressure like this. It may just trade sideways, but that's the kind of pressure that it's under. It wants to break higher, but it can't because there's just enough people out there selling in order to raise dollars. And that there's going to be that push and pull in the gold market now, I think, for a while. And it could last a couple more months. Okay? But it's good that it's doing this at 1,300 and not 1,100. Let's just, let's not cry in our beer too much. Okay? Oh, sorry. All right. So note also, this is the daily chart of the U.S. 10-year Treasury. Just wanted to note that we had this massive rush into Treasuries from during March, and then we had a little bit of a relief rally where there was some selling. That's just normal. This is just profit taking. And then looking at today's action, we've got potentially a 2-bar reversal, and then on the daily chart here. Note also that this reversal off of this downtrend was not a 2-bar reversal. It was a 4-bar reversal, which meant this is a very weak signal. So I'm not surprised that we get to the next quarter point, and gold and the 10-year can't move. This is, central banks are back into buying now. They sold for a little bit, and now they're buying again. And why are they buying? They're buying to shore up their ability to be able to move into the dollar markets with high-quality assets to sell them and defend their currencies. So they're reloading. And that's what they do. Okay? German stocks. I just wanted to note, remember that I've been saying for a while now that I expect the Dow to continue to outperform both the German DAX and the UK FTSE. I haven't been wrong about this. And the reason I haven't been wrong is because German stocks are in trouble because the German economy, as I wrote last week, is on the verge of imploding, regardless of Brexit. This is a Brexit relief rally on the hope that, this is the Brexit relief rally on the hope that Brexit's going to be scuttled. This hasn't really been in any way a rally to say that that German companies aren't going to do well because Theresa May keeps trying to push through a Brexit deal that is good for Germany, and this is the proof of that. But that's the upper limit of the rally. This is the upper limit of the rally, up around 12,000. It's in this whole area right in here. You can see the cluster of resistance that happens. I'll be even shocked if it can hold 12,000 on a weekly or monthly closing basis at this point. There's just too much resistance here. I fully expect to see this drop as the year goes along, regardless of what happens with Brexit. Even if, it would be especially telling how bad the German economy is falling off cliff if the German stock market, fails to rally significantly. It could just trade sideways, mind you, because again, to everything I said about the U.S. stock market as a corollary is going to happen to the German stock market, just lesser, right? So while we're going to get a massive rally in the Dow, we may get the German stocks not breaking down, even though they should. Right? Flight to quality, because German bonds are way overpriced when they're at their negative yields out to 10 years now. All right. As if you think this was a big move in treasury rates, German bonds put this to shame. Okay, and that tells you just how weak and how scared everybody is in the European capital markets. All right, and then the last thing I just want to talk about is to follow up on the Dow. Right, so look, big, huge rally in the Dow, which is continuing, and this is your gap and breakout. It hasn't been from last week, hasn't been filled. We've had low volatility this week, but it's only Wednesday morning. I'm doing this right after the market opens, so God knows anything could be happening. But we're within a couple of 100 points of an all-time high on the Dow, and I don't think that we're going to see any. I don't think we're going to see a correction before we see a new high on the Dow. I just don't. Even with opening low this week, all we're doing is just testing this breakout point for a couple of days before it goes higher. All right, so that's what I've got for today. By Sunday, all the rules could change, right? So, all right, I'm gonna run. I got my partner pinging me that I've got to talk to him about getting the issue done. So I'm gonna run. You guys take care. You have a great afternoon. We will talk soon. Keep your stick on the eyes.